Research at Citi Markets Edition.
Welcome to Research at Citi Markets Edition, where we break down global macro in 10 minutes or less. I'm your host, Dirk, Citi's Global Head of Macro, and with me today is Adam Pickett, our London macro head. Welcome to the show, Adam.
Thanks, Dirk. It's an honor to be back.
We are recording this podcast at 9 a.m. on Friday, June 12th, 2026. The question we're trying to answer is, why did equity markets pull back, and is it over now? And how significant are the risks from the upcoming FOMC? So let's start with equities. We have this pulse indicator to warn us of over-optimism in equity space, and that actually triggered in late May. Now, the most important question is, though, how do you get back into the market? Because it's just a tactical indicator. It warns you of a 4 to 5% pullback, but it doesn't tell you the bull market is over. So there's no point to use these indicators without a strategy for going back into the market. So we ran a bunch of tests to see what gets you back in, and we like volatility risk premium. We like if the indicator actually falls significantly. But almost the easiest solution is just stay out for a month, and that usually does the trick. Now, of course, it's purely technical, and really more interesting question is also whether fundamentals have changed or not, right? Because that might make you much more willing to buy the market back much more quickly. And that's a big debate. I mean, there are a bunch of different stories for why the market may have sold off in the first place. And Adam, I have some views, but Adam, what are you thinking? What caused the pullback?
Yeah, we get told about, IPO risk. We did plenty of testing around the glide path of the S&P after historically very large IPOs, where the amount raised was in the sort of 0.05 to 0.1 range of largeness in terms of the size of the S&P market cap. Again, not a great signal. We looked IPO issuance in aggregate as a signal, no dice. On rate sensitivity with respect to the hawkish Fed and inflation surprises, there wasn't a massive rates beta going through the unwinds when we looked at the data. If anything, Occam's razor kind of told us that one of the simplest answers was the best, which is that there are a lot of jitters. There was some complacency as triggered by polls, but effectively, since the Iran lows up until the polls indicator and then after the polls indicator triggered, what went up the most went down the most, which is to say it was a wholesale positioning reduction. We saw this across US sectors, US quant factors, global equity indices, and even G10 FX. There was a pretty wide dispersion between, say, the Kospi and the TAIEX performance, which tells me it wasn't necessarily all about AI. And there was a pretty small dispersion between the recent sell-off in S&P and Russell, which again tells me it's not necessarily a totally growthy dynamic. But Dirk, in what sense? I guess the point I'm trying to get at is, if it was all about downgrading expectations of the AI narrative or growth narratives, I would have expected Taiwan and Kospi to fall together in similar sizes. I would have expected the S&P to fall a lot more than the Russell as well. But it just seemed more like there was quite a broad amount of unwinds, and that effectively recent moves to the upside were a good indicator for how much stuff fell.
And in some sense, it's reassuring, right? So if it's mostly about positioning, you would think that, yes, you have to clean up positioning a little bit, but then you should buy the market back maybe somewhat faster than the 22 trading day rules that I mentioned before on our indicator. And of course, we got this Iran headlines. And I think, again, the market is, of course, a little bit cautious on them, maybe because everyone has been burned many times trying to read too much into these headlines. But I think one decent rule of thumb is that you sort of ignore the positive headlines that come from a US source, but you don't necessarily ignore the positive headlines coming out of Iranian sources, because they had a very negative bias throughout this whole episode. And so the fact that we got some reassuring headlines out of Iran, maybe that means it is more likely that we do actually get a deal. And what's your sense, Adam? How would you treat this Iran headlines? And especially, what does it mean for equities if we have already cleaned up positioning a little bit as well?
Obviously we need to see it follow through, but we've written this before, and I think it's still valid that, in the short term, Europe probably looks better as a bounce back candidate. The positioning looks the most negative across our equity positioning monitor product from our equity colleagues. And a simple overlay of Euro stocks versus S&P 500 against WTI tells you that if WTI is set to fall further, then and Euro stocks should outperform. On the dollar, we probably want to buy a dip. Most of the quant factors, apart from terms of trade, are still in favor of the US, relative data momentum, relative to rates, relative equities. But I think a pullback probably makes more sense to get back involved in the dollar. So we're kind of cautious. But, another big factor, I think, both on the risk dynamic as well as feeding into the dollar and rates debate has been the Fed, massive repricing of the US post the Iran conflict. And we've got the FOMC coming up. Dirk, can they swerve the market pricing? Does that back them into the corner? What's the story there?
Yeah, that exactly. I wanted to get to that. It's the second big event, so Iran and the Fed before World Cup can set in here, and people take off a bit of time from trading. And it's very interesting, actually. We had a look when the market almost fully prices the Fed hike 6 months out. How reliable is it? And the answer is the market's not very good at it. Of the episodes we found, really, there was only a 35% hit ratio where the hike actually happened in 6 months' time or before, and it drops further if you just focus on the first hike of a cycle, because it gets easier as the cycle moves on. So it doesn't mean that much by itself, what the market is suggesting. So the FOMC meeting will be very, very important, because it's more important what Wash is suggesting, or what the committee are suggesting. And so it will be a really important risk event. And so we looked at both scenarios to just figure out what the trade is, or how people should position in case you get either a hawkish wash or a dovish wash. And for the hawkish wash, it's quite easy. I mean, I think given how much hawkishness is priced in already, that means to be very hawkish, you need to have the September meeting in play for a rate hike. And then if that were to happen, we are now in the 3-month window. If you look at the 3-month window, US rates sell off strongly into the first hike, obviously, as you would expect. The dollar strengthens clearly into the first hike, also as you would expect. But interestingly, the S&P is fine. So it comes back a little bit to the point that you were making, that it's not clear that interest rates here would necessarily end the bull market in equities. And I think that also rings correct given the 2000 episode where the Fed really had to hike 175 basis points and remove liquidity aggressively for the S&P to peak, while this time around we haven't even hiked once, right? So that is a bit reassuring on the equity side. But it's also not Citi's base case, right? Citi's base case is we don't get a very hawkish Fed, and Kevin Walsh will be able to persuade the committee to sit on their hands at least. So, Adam, if you get the Citi base case more dovish outcome, what typically happens in that case?
Look, the obvious conclusion is that the S&P is fine. I mean, you could be forgiven for thinking maybe it wouldn't be fine. Maybe they aren't following through with hikes because something has broken. But generally, that's not the case. The other interesting thing is that you don't really get a major pullback in rates, or it's fairly short-lived if they decline to hike, so to speak. So arguably, unless you think the tightening cycle has been completely derailed, you probably do want to pay the small dip in yields.
Yeah, no, very good point. I mean, sometimes in the study, of course, it did happen that there was an actual crisis and there were cuts. But I mean, these financial market crises are, of course, very hard to forecast. A, and B, at this stage, it doesn't seem obvious where they would necessarily strike from. So in summary, our warning indicator would suggest some patience to re-enter, but the Iran deal seems plausible enough that European equities are tactically attractive. The upcoming FOMC will be the last important market event before the focus will shift from markets to soccer. We believe Chair Ward can hold the line against more hawkish FOMC members. And even though that will happen, rallies in rates may be somewhat limited. The same is true for the dollar, where sell-offs on the back of Iran may also be shallow. Thank you for joining us today. This episode was recorded on June 12, 2026, and I'm your host, Dirk. For more details, Citi clients can check out our reports on Citi Velocity. Next week's Research at Citi Markets Edition will be hosted by Beate Menthe, Citi's Head of Global Equity Strategy. And be sure to watch our Research at Citi podcast, which you can view on the same channel. The macro strategy team will be back in 2 weeks. Stay sharp.
This podcast contains thematic content and is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information, and although obtained from sources believed by Citi to be reliable, its accuracy and completeness are not guaranteed. Past performance is not a guarantee or indication of future results. This podcast may not be copied or distributed, in whole or in part, without the express written consent of Citi. Copyright 2026 Citigroup Global Markets, Inc. Member SIPC. All rights reserved. Citi and Citi and Arc Design are trademarks and service marks of Citigroup Inc. or its affiliates and are used and registered throughout the world.